What is foreign exchange market? Foreign exchange market is the market in which currency of one country is exchanged for currency of another. Foreign exchange rate is the rate at which one currency is exchanged for another currency. The next slide I'm going to talk about is currency appreciation and currency depreciation. Currency appreciation is the rise in value of one currency in terms of another currency, and currency depreciation is the fall in value of one currency in terms of another currency. Foreign exchange demand, interest rate in different countries, and future exchange rate. The quantity of a currency such as US dollar demanded in the foreign exchange market is the amount that traders plan to buy during a given time period at a given exchange rate. The demand depends upon the exchange rate, the interest rate in different countries, the expected future rate, example Euro-US dollar rate forecast. Law of demand for foreign exchange states that if all other things remains the same, the higher the exchange rate, smaller is the quantity of currency demanded, and lower the exchange rate, bigger is the quantity of currency demanded. The influence of exchange rate on the quantity of currency demanded is because of two primary reasons. Export effect. The value of export is dependent on exchange rate. The larger the value of exports, the larger is the quantity of currency demanded to pay for those exports. And the second one is export profit effect. The expected profit is dependent on the exchange rate. The larger the expected profit from holding a particular currency, the greater is the quantity of the currency demanded in the foreign exchange market.
People do not buy dollars because they enjoy them. The demand for dollars is a derived demand. The term derived demand is used in economics, meaning a demand for one good or service occurs as a result of demand for another good. For example, people demand dollars so that they can buy U.S.-made goods and services, also known as U.S. exports. We also demand dollars so that we can buy U.S. assets, such as bank accounts, bonds, stocks, businesses, and real estate. In foreign exchange, other things remain the same, and the higher the exchange rate, the smaller is the quality of dollars demanded. So, if the price of the US dollar rises from 0.7 euros to 0.8 euros, but nothing else changes, the quantity of US dollars that people plan to buy will decrease. But why does the exchange rate influence the quantity of dollars demanded? In order to answer that question, we will be looking at the export effect and the expected profit effect. The export effect. The larger the value of United States exports, the larger is the quantity of dollars demanded. However, the value of United States exports depends on the exchange rate. For example, let's say the exchange rate falls from 0.7 euros to 0.6 euros per US dollar, which makes US produce goods and services to people in Europe cheaper. The United States exports more goods and services as a result. The quantity of US dollars demanded to pay for those goods and services goes up. This is the export effect. Next, we will look at the expected profit effect. The expected profit effect. The larger the expected profit from holding dollars, the greater is the quantity of dollars demanded in the foreign exchange market. But the expected profit depends on the exchange rate. The lower the exchange rate, with other things remaining the same, the larger is the expected profit from holding dollars, and the greater is the quantity of dollars demanded. To get a better understanding of the expected profit effect, let's look at another scenario. Suppose that you think the dollar will be worth 0.8 euros by the end of the month. If a dollar costs 0.75 euros today, you buy dollars. But a person who thinks that the dollar will be worth 0.75 euros at the end of the month does not buy dollars. Now suppose the exchange rate falls to 0.65 euros per dollar. More people think that they can profit from buying dollars, so the quantity of dollars demanded today increases. Here's a graph that shows the demand curve for US dollars in the foreign exchange market. Next, we will look at the changes in the demand for dollars. A change in any influence other than the exchange rate on the quantity of U.S. dollars that people plan to buy in the foreign exchange market changes the demand for U.S. dollars and shifts the demand curve for dollars. These other influences are described next. The first influence is interest rates in the United States and other countries. United States interest rate differential is the U.S. interest rate minus the foreign interest rate. Other things remaining the same, the larger the U.S. interest rate differential, the greater is the demand for U.S. assets and the greater is the demand for dollars on the foreign exchange market. The second influence on change in the demand for dollars is the expected future exchange rate. Other things remaining the same, the higher the expected future exchange rate, the greater is the demand for dollars, and the higher the expected future exchange rate, the larger is the expected profit from holding dollars. Therefore, the larger is the quantity of dollars that people plan to buy on foreign exchange market.
The quantity of U.S. dollars supplied in the foreign exchange market is the amount that traders plan to sell during a given time period at a given exchange rate. The amount or quantity of the money which they plan to sell depends on the same three factors that influence the demand side of exchange rates: the exchange rate, interest rates in the USA and other countries, and the expected future exchange rate. However, these work in opposite ways of which they influence demand. The traders in the foreign exchange market buy currencies so that they can buy foreign goods and services, also known as imports. Also, traders supply dollars into the exchange market and buy foreign currencies so that businesses and people can buy foreign assets such as bank accounts, bonds, stocks, businesses, and real estate. If you were to purchase a villa in France, you would need to purchase euros from the exchange market to buy your new European estate in their currency. After ceteris paribus, other things remaining the same, the higher the exchange rate, the more dollars which are supplied into the exchange market. So, when the U.S. dollar rises in the market to equal 80 cents from its original 70 cents, the amount of dollars that people plan to sell into the market goes up. The main two reasons behind this is the same as those behind the law of demand of foreign exchange: import effects and expected profit effects. When reviewing the imports effect, it stands that the larger the quantity of imports to the U.S., the larger amount of U.S. dollars supplied on the foreign exchange market to pay for these imports. When people buy foreign currency to pay for these imports, they supply dollars. So the more U.S. imports, the more dollars supplied on the foreign exchange market. The higher the exchange rate, the cheaper the foreign-made goods and services to us Americans. The other reason the exchange rate influences the quantity of dollars supplied is the expected profit effect. When a currency is expected to gain a larger profit than other currencies from holding, there is a greater demand for the currency and therefore more dollars are supplied to gain it in the foreign exchange market. This expected profit depends on the exchange rate. When the exchange rate is high, so is the profit from selling dollars, and vice versa.
Some things that influence the U.S. dollar are interest rates in the U.S. and other countries, as well as the expected future exchange rate. If there is a change in any influence on the quantity of U.S. dollars that people plan to sell in a foreign market, it changes the supply of dollars in that market. Because of this, the supply curve of the dollar shifts. The larger the U.S. interest rate differential, the smaller the demand for foreign assets, and the smaller the supply of dollars in the foreign exchange market. If the supply of dollars in a foreign market is small, then the expected future exchange rate is high. For example, if the exchange rate today was 0.70 euros per dollar, but was expected to reach 0.80 euros per dollar by the end of the month, you would likely wait to convert your money. Therefore, there is less money circulating now. This slide shows an increase in the supply of dollars and a decrease in the supply of dollars. Supply and demand in a foreign exchange market determine the exchange rate. The exchange rate acts as a regulator. If it is too high, there's a surplus, and if it is too low, there's a shortage. The foreign exchange market is constantly pulled to its equilibrium point because people are constantly looking for the best prices that they can get. This slide shows that if the exchange rate is at 0.80 euros per dollar, this causes a surplus and the exchange rate falls. And if the exchange rate is at 0.60 euros per dollar, there is a shortage and the exchange rate rises. Everyone in the foreign exchange market is potentially either a buyer or a seller. Supply and demand are not independent. They change in opposite directions, and it results in a large price change and small quantity changes. A rise in the U.S. interest rate differential increases the demand for U.S. dollars on the foreign exchange market and decreases the supply. The same goes for vice versa.
Exchange rate expectations change due to two factors. They are purchasing power parity and interest rate parity. Purchasing power parity. Money is worth what it will buy, but two kinds of money, US dollars and Canadian dollars, for example, might buy different amounts of goods and services. Suppose a Big Mac costs 4 Canadian dollars in Toronto and 3 US dollars in New York. If the Canadian dollar exchange rate is 1.33 Canadian dollars per US dollar, the two monies have the same value. You can buy a Big Mac in either Toronto or New York for either 4 Canadian dollars or 3 US dollars. This situation just described is called purchasing power parity, which means equal value of money. Exchange rate expectations change due to the interest rate parity as well. Suppose a Canadian dollar bank deposit in a Toronto bank earns 5% a year and US dollar bank deposit in a New York bank earns 3% a year. Why does anyone deposit money in New York? Why doesn't all the money flow to Toronto? The answer is because of exchange rate expectations. Suppose people expect the Canadian dollar to depreciate by 2% a year. This 2% depreciation must be subtracted from the 5% interest to obtain the net return of 3% a year that an American can earn by depositing funds in a Toronto bank. The two returns are equal. This situation is one of the interest rate parity, meaning equal interest rates when exchange rate changes are taken into account. Monetary policy and the exchange rate. Monetary policy influences the interest rate, so monetary policy also influences the interest rate differential and the exchange rate. If the Fed were to increase the U.S. interest rate and other central banks keep interest rate on other countries unchanged, the value of the U.S. dollar rises on the foreign exchange market. If other central banks increase their interest rate and the Fed keeps the U.S. interest rate unchanged, the value of the U.S. dollar falls in the foreign exchange market. So exchange rates fluctuate in response to changes and expected changes in monetary policy in the United States and around the world.